And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
Luke Smith, good afternoon.
Good afternoon.
Here you are wandering into the studio in your summer weight white T-shirt.
Here we go.
And we've turned up the air conditioning for you.
Makes me look less fat.
We're almost here to wrap up 2025. Yeah. We're going to take a look at some of the misconceptions that have crossed your desk in this past year. People have come in to have a chat with you and they've opened their mouth and said something and you've had to pull them up and say, well, hold your horses, that's not actually correct.
True. Or I may have just smashed them and said, what are you talking about? So it depends on the day. Depends how early it is in the day. In the morning, I'm very understanding. In the afternoon, no, that's dumb, moving on. So,
well, the reason we are talking about this, of course, is that misconceptions can, in the end, cost you money.
Yeah. And I think that's really the premise of today, is to point out and highlight that chat around the water cooler, down the fairway at golf, at mahjong, at knitting, whatever you may be doing, you need to try and understand and get help from someone in that space, because you can go off on a tangent and watch something on TikTok or watch something on Instagram from somebody that legally probably can't comment, but we don't have the mechanics in place to be able to sort of protect people on those platforms. So don't just assume that everything you hear is legitimate and accurate. Get some help, get some advice, or just ask somebody that knows, because it'll be like me making comments about electrical stuff. When anybody that knows me knows there's 100% chance I'm electrocuting myself, regardless of what Google says is going to happen. So today's about what I've heard, what I've had to explain, and what someone has actually come in and told me is so according to their friends. So
you wouldn't be getting medical advice from your mechanic. You wouldn't be getting brain surgery done by your plumber. And so you shouldn't be taking financial advice from people that really are not that expert in what they're talking about.
Yeah, and I think you also need to keep in mind, I say this to a lot of people, it doesn't matter what someone else did. What do you need to do? And the government are very good at this, right? The government's a very incestuous environment because they've got super funds that are different to some others. And everybody in there is an expert because they must spend a lot of time Googling about what they can do, but also then the collective discussion around what did John do, what did Jenny do? Oh, Leon, that's what you need to do. And I often say to people, so you have a thorough understanding of his financial situation, do you? Oh, well, no. Okay, so why would you go and do what he did without that background information? Oh, okay. And I get this one. When you put it like that, well, there isn't any other way to put it, but let's just say that's so.
All right, so what are some of the fundamental misconceptions that have been holding people back and costing them money?
So, first one I get all the time is, I've retired now, I can't add any money to super. Wrong. You can make two types of contributions, a deductible contribution and a tax-free contribution. You can make a tax-free contribution up to 75, provided you have room in your caps. And you can make a deductible contribution while you are not employed, up to 67. And that's completely fine. You might have sold an investment property and have a capital gain on the sale of that property, and you sold it after you finished working because you wanted to minimise the tax. Great strategy, well done, well executed. But why not put $30,000 in up to the concessional limit so that you can lower the capital gains on the sale of a property? So again, don't assume you can't, because it could be costing you money if you are liquidating or changing any existing asset and the philosophy of said asset.
All right, but Luke, doesn't it make a difference if I've already turned my superannuation away from accumulation and into an income phase, into a what do they call it, a pension phase?
No.
Makes no difference?
No. All you do is open up another fund. If that was me, let's say I was 60 and I'd retired and I'd sold an investment property the next year because I was going to add the money to super. I'd finish work at 30 June. I'd sell the place in July. I'd work out what the capital gain is. I'd make a super contribution to a new fund because I may have started a pension when I quit work. I'd claim my deduction, and then I'd just pull my money out of the superannuation fund, or I would make my contribution into the second fund, claim my deduction, then I would stop my pension. I'd pull out the money that I put in. I'd get the proceeds from the sale of my investment property. I'd make a non-concessional contribution into my pension and turn it back on. So that's probably a good segue into another one that I've had. I've started my pension, so now I need a second account. No, you can stop a pension. Now, for clarity, you can't stop a defined benefit. So I'm not talking about CSS, PSS, DFRDB, MSBS. The defined benefit income stream, that's a different unicorn. It has a different horn. I'm talking about a normal superannuation fund where you've commenced an account-based pension. You can stop an account-based pension. By stopping it, it goes back to accumulation phase. You can add more money, and then you can start the pension again. You don't have to run 2 or 3 pensions from an admin perspective unless it is strategically appropriate for you to do so. Another one I get is, my balance is over $500,000 today. I can't use the catch-up legislation. No. What was your balance at 30 June in the previous financial year? That is the measure and the line in the sand that determines your eligibility for the next 12 months. So we could be sitting here on the 12th of December and go, I want to put $50,000 in as a tax deduction because I haven't used my previous 5 years of cap space. This is my last year of gainful employment and I want to bolster my super. But today my balance is $520,000. What was your balance at 30 June 2025? It was $490,000. Lovely. You can make the contribution. Lodge your notice of intent, get your tax deduction and play on. So remember, it's not when you make the contribution, it's the 30 June of the previous financial year that determines your eligibility to use the catch-up concessional legislation. So be mindful of balances getting close to 500 because you want to try and utilise that where possible, even if you pull money out of an offset account. The next one I get all the time is, I can only make a contribution of 10% to the PSS. No. You can make a 10% contribution as the maximum to the PSS, and then you can make a deductible contribution using the available cap space that you have from the annual limit of $30,000. If you don't know what your limit is, get your 2025 statement, and this will be a great way to find the example. Go to page 5 of a PSS statement. Go to the bottom of page 5, there's a box. Second row of that box, it says, concessional contributions counting towards my concessional cap in 2025. That number in that box is what the PSS has recorded against your $30,000 limit. And let's say, for example, it was $10,000. That says that you could make a $20,000 deductible contribution to another super fund, not the PSS, and claim 100% of that money as a tax deduction. So if you're in the PSS and you're not making a contribution to another fund, you're leaving tax savings on the table. But the number that you're working with in this example is retrospective because the 2025 statement is for that financial year. If you want this year's number, call them up and say, what's recorded against my concessional cap? They will read it out to you over the phone because it's set on the 1st of July. You can also log in and get it on the website where they show you concessional and non-concessional contributions. So keep that one in mind because there's a huge tax saving there that I find a lot of people are leaving on the table. Again, because of the water cooler talk, you can only do 10% into the PSS. Yes, to that fund. But what about another fund? You're not precluded from using another fund. So make the most of what's available. This one's a belter, and all of the shows we've done on this one, it still surprises me people say it. My kids won't pay any tax when I die if my money's paid out of super. No, not necessarily. If you have taxable component and it's paid to a non-dependent child, your kids will incur a 17% tax liability. And that's why in previous shows we've banged on about a recontribution strategy where you'd pull money out and put it back in as a non-concessional contribution because tax-free component goes to adult children on a tax-free basis. So if you do retire and you look at your statement, it says, I have 100% of my benefit as a taxable component, you should be actively doing something to reduce that to avoid the death tax that's built into the superannuation legislation. The next one I get all the time is, I don't want to use an industry fund, so I need to leap to a self-managed super fund. No, it's just an option. So an industry fund is one type of super. A self-managed super fund is, at the other end, a wonderfully flexible vehicle that is very misunderstood. But in the middle, you have what's called a retail super fund. okay, or a personal super fund, where somebody acts as the trustee for you. You are not the trustee of this fund, but generally speaking, they have a very, very broad investment menu. They have a wonderful options in relation to listed shares, ETFs, managed funds, converting preference shares. They are taxed at a fund level, which means how your portfolio is invested is then taxed for your benefit, unlike an industry fund that is taxed at a fund level where you have no control over franking credits and anything like that. So just keep in mind that if somebody says to you, well, we may not use an industry fund, that does not mean we're leaping to self-managed super, because whilst they're wonderful, they're not right for everybody in every situation. And I've had a number of conversations this week about why someone may or may not use one. But a lot of people miss the personal super fund in the middle and just assume that it's left or right in relation to the options that they have. That sort of segues into SMSFs. Oh, I can't have one of those, they're expensive. No, not necessarily. And here's another example of a generality. A self-managed super fund with a large capital base is the cheapest superannuation structure in Australia. A self-managed superannuation fund with $500,000 in it is not cheap. But if cost is your primary driver, I think you've already got problems, because people use a self-managed super fund for a range of strategic reasons, and the vast majority of them are not cost. Yes, cost is important, but not to the detriment of strategies and investment opportunities that are appropriate for you. So don't assume, oh, I don't want one of those, they're really hard and they're really expensive. They're not. They're probably some of the simplest and easiest things to administer because of the flexibilities that are available to you. And between a couple, if you have, I'd even go as far as say, if you've got more than, say, 1.2, 1.3 million, they're cheaper than any industry fund. Because people go into those vehicles for control for specific reasons. Another one, I have this one, and I get this one all the time. I've got a will that'll sort my super out. No, it won't. My keys will not start your car. So think about it like that. You need a binding death nomination in your super fund to direct where your super is paid. If the binding death nomination directs the superannuation to your estate when you die, then it falls under the umbrella of the will, and then the will can disperse the assets per your wishes in that document. And hopefully you've had good advice, and you may have testamentary trusts for the kids that offer some asset protection and a range of other benefits. So again, that's not something that I would be flirting with or guessing with, because at the end of the day, your accumulated superannuation is generally one of your two biggest assets outside of your family home. And controlling where it goes and understanding the tax implications is vitally important. Another one I get is, I've got two super funds. I need to combine it into one because it's cheaper. No, not necessarily. This assumption, or this cool water cooler talk of two funds, into one fund is better. No, not necessarily. I think it's a silly generality to have, because you may have two super funds for a range of different reasons. You may have insurance in one that you don't have in another. You may have investment options in one that you do not have in another. You might have particular holdings in one and a weighting to something. You might really like a share and hold hundreds of thousands of dollars in a self-managed super fund in one investment. You can't do that in an industry fund. You can't do that in a retail super fund, because both of them generally have caps on how much you can have in any one asset. So if you want to be rolling the dice in something, you want to be able to do it in a vehicle where you can control the weighting of the asset. You might also then have estate issues where you want one super fund paid to one part of the family, one super fund paid to another part of the family. So rolling everything together, but the perception that it's cheaper. If you've got two funds with $500,000 in them, it is not going to be significantly cheaper if you have $1 million in one. So again, think about the cost and the opportunity that you're foregoing by making that general sort of assumption and rolling everything together, because it could be a lot more expensive than you realise.
Luke Smith from Envision Financial is in the studio today explaining how misconceptions can cost you money. We've actually not ticked every box on your list, because there's so many of them, but what are the key things to remember?
Yeah, I think firstly, don't assume. Assumptions can be really expensive. Don't guess, because I often know if people come in and sit down and I say, "Oh, well, you could do this, this, and this," and the look on their face, they go, "So I should have been doing this like 5 years ago," and I go, "Well, yeah, but you didn't know, so don't worry about it." Use the rules to your advantage. If you can make a deductible contribution to lower the tax on the sale of an asset, don't pay any more tax than you have to. They're doing a great job of spending it on their own travel at the moment anyway. So let's not give them more to spend on, parking cabs outside and whatever else has been going on this week. Be prepared. With a lot of these strategies, there are limits and thresholds that need to be adhered to, and there are caps, like we said before the ad break, about 500,000 in super for the catch-up rules. If you're prepared and you're thinking about what is or isn't available and then how you're going to execute it, there's nothing more frustrating when someone comes in and I said, "Oh, well, have you used this?" And they go, "No." "That's great." "Oh, but I've got 520 in my super fund." And they've missed out on the opportunity to use wonderful legislation that could have saved them thousands of dollars in tax. If you think forward and even if you just look 12, 24 months in advance and just check out what you can and can't do, am I using it to its fullest potential? The contribution one with the PSS and defined benefit, that's a cracker, right? Everybody comes in and goes, "Oh, I'm maxing that out." No, you're not. "Oh, but I could have." "You mean I should have? And I better?" Yeah. So find the money from somewhere and put it into super. But understand what you can and can't do and then choose if it's right for you. We're not saying people need to do all of this. We're not saying that none of it's applicable. What we're saying is use the thing that's right for you, like a super fund. There are various types of super funds that have various types of features, just like a car. And I'm forever banging on about a car. And I say all the time, a Mini won't pull a horse float. That doesn't mean we don't like Minis. And I said that to a lady today. "What would you like?" "I'd like this, 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 and this." You can't have that there. So we need to use this. That doesn't mean that one's bad. It's just not something that we're going to use to maximise our control and flexibility when we go into retirement. So avoid the assumptions, get some facts, execute the facts, and have a strategy and a plan going forwards, and you'll maximise how you accumulate your wealth.
Well, I think one of the assumptions that we skipped over was you need $10,000 at least if you want to start investing. We might use that as a topic for another day. What do you reckon?
Done.
I think that's a good plan because there are ways to invest with less than $10,000 and it's worth getting started.
I think it also depends how hard you go at Christmas.
Yeah, well,
that might have to be a February topic because...
Well, that's right. Yes, indeed. So where can listeners get more information?
Yeah, so office number 62604749. We've got envisionfinancial.com.au on the internet. We've got the Strategy Stacker Luke Talks Money on iTunes and Spotify. We've got Envision Financial Canberra on YouTube where you can subscribe and get a back catalogue of over 250 shows. And we've got Smart Money Strategy, your ultimate guide to financial planning, in all good bookstores and online. Wonderful Christmas gift. We've only been saying that for the last 6 months.
Well, that's right. It's always good to plan ahead for Christmas. Here I was going to get all my Christmas shopping done early and I still haven't started.
Well, I think we just last minute's the best ones.
It is. Well, there's an explanation for that theory, but I'll have to share that on another occasion. Thanks very much.
No worries, mate.
Luke Smith from Envision Financial back with us again next Friday.